going up to like 0.25%, I'd text my brother and be like, high five, let's go. We're getting a quarter basis point because it was almost always at zero.
Hey everyone, and welcome back to the Retire While You Work podcast. Miles Zuger, wealth advisor here at Adams Wealth Partners, joined by Carson Odom, another wealth advisor here at Adams Wealth Partners. Today, topic that we're going to be touching on is just various cash accounts. So checking, savings, money markets, CDs, just all types of accounts out there for cash, and maybe how to best strategize around these, where it makes sense to hold cash, various amounts, just to try and optimize things. I think you look back to, really 2016, 17, 18 to 2023. I mean, it didn't really matter where you held cash because you were maybe making 1 or 2%. And then you see rates jump up, beginning in 2022, 2023. And we're sitting here with, money markets, savings accounts paying, various amounts, anywhere really from 3 to call it 5.5% on the high side. And so it matters. You can actually get a little bit of yield on your cash while it's sitting there with some safety. So we just want to touch on this and, from a financial advisor, financial planner's perspective, talk about what we think makes most sense for, people out there. But again, it's at the end of the day, it's what makes sense for you as an individual and how you're managing household finances. That is just the easiest for you. So the goal today is just to try and optimize things a little bit, or give you some advice on maybe how you can optimize your cash savings.
I think a lot of our conversation is going to end up revolving around interest rates, ultimately, different types of accounts and how to choose. And it's so interesting because, interest rates generally in my professional career have always been basically zero. Up until the past couple of years. And I remember even back in, when was it when rates started to go up in like 2018, 2019?
Yeah, it was like the end of 2018, like around Christmas time.
And I remember getting
spiked at one point.
An email from my savings account saying that it was going up to like 0.25%. I'd text my brother and be like, high five, let's go. We're getting a quarter basis point because it was almost always at zero. And as soon as it got up, I think it got up to a couple percent. But then, of course, COVID happened, interest rates got slashed to zero again up until they started raising in March of 22. So, it's the decision comes down a lot of times to interest rates. Where can you get the best rate? But it's also some pros and cons to some different accounts. So let's just go first and foremost, different type of cash account, checking account. Everybody's got to have a checking account. Personally, tons of institutions out there, different types of institutions can offer a checking account. And I am a fan of just a traditional bank checking account. Have your banking, have your investments be separate. I think we tend to recommend that, and have a banking relationship. And that's personally what I do. And it's a checking account. Maybe they charge a monthly fee, probably not, but you have a debit card, you pay your bills out of. I think that's pretty standard. Having a checking account. How much should you keep in a checking account? 1 month's worth of expenses. That's generally, I don't know about you, how you and your wife operate, Miles, but I think 1 month worth of expenses in a checking account is a good thing.
Yeah, I think, obviously the checking account is a piece of the emergency fund. And I would say a savings account, which we'll touch on here in a second. But yeah, I feel like we hear all range of that. We hear people that have just their entire emergency fund sitting in their checking account. We hear people, on to Carson's point, people who have maybe a month's worth of savings in a checking account, basically where paychecks and earnings are coming in, and it's not that spot that you're really trying to save. You're just kind of money coming in, money going out, or maybe you have it automatically directed to investment accounts or a portion to a savings account on top of there. So I think it can be all over the place. You probably have at least a month or two in there. I don't know if you're able to, maybe as much as kind of that 6 months emergency fund. Again, if rates are at zero, it doesn't really matter because you're getting 0% on whatever amount is 0%. So
that's true.
It's not as big of a deal. But when rates are up, that next spot to look at is savings accounts. So, on a regular savings account or money market account with FDIC insurance, for the most part, they're the exact same thing.
And
On the low side, you should be able to get at least 3%. On the high side, maybe 5.5%, depending on your bank or your institution. And inside of there, if you're only going to keep a month's worth of expenses or cash, you should probably have 4 or 5 months in the savings account.
right. And I was just going to comment, if you get, interest rates aren't paying much, checking accounts, generally their interest rate's going to be close to zero. Nobody's really paying a high amount of interest on a checking account. But if you view everything as just one account checking, it's just savings, everything. Personally, for me, I think it's just mental accounting. I like to view my checking account as that's what I'm operating out of. It's for spending. Savings account is separate / money market is separate, and that is. I just like to visually see it. I don't know. I'm a visual person, and obviously have an accounting background, so I like to have stuff separated out. Some people go even further than that. And, if you have a vacation fund you save for, car fund, this, that, and the other, you may have 6 different savings accounts. I think that's great. I think that's perfectly fine, especially if you have an institution that's not going to charge you a fee for opening those separate accounts. Nowadays, different banks you can have buckets inside a savings account to, again, allocate certain amounts for different buckets of money. But I think, personally, I'm a fan of separating it out. So yeah, like you said, savings account, money market account. Nowadays, interest rates are higher. So there is the incentive for having a checking and a savings. Nowadays, with interest rates, call it maybe you can get anywhere from 4 to 5%. It can always change. That is the incentive for having a separate savings account. Now, there are restrictions. I don't know how much you remember off the top of your head, Miles, but I think one of the restrictions is a lot of times banks will limit the transactions on a savings or money market. And
that's what I was. I think the limit's 6.
Okay. Yeah.
At least where I bank, I think it's 6 a month. I think that's pretty standard. So and maybe the variable for you is you want to have money in savings to maximize that interest, but the biggest thing is just making sure that you're not going over those 6 withdrawals because they start to penalize you and withhold some interest if you do that. So that's one thing, and maybe that's what makes your decision up. Or maybe you're somebody who just at the beginning of the month, you just say, hey, I know bills are going to be X amount. If all of your money's in savings and your checking is a little bit low, you move over X amount to make sure that all your bills are paid for that month. And you're just doing that once or twice a month to cover things. If there's maybe a surprise pop-up that you need to cover also.
That's it. So whether or not it's a savings or a money market, don't get too caught up on the difference between those couple of accounts. The savings and money market, pretty much the same. They might have a little bit of a different interest rate depending on the financial institution that's offering it, but pretty much the same. So that leads us into the next route of CDs, or a certificate of deposit. They were popular when interest rates were higher. They were not popular in the 2010s because interest rates were basically zero. So with CDs, they have certificate of deposit. They're a little bit different as they have a term, meaning they might have a 3-month, 6-month CD, and you put your money in a CD. You cannot touch it until that term is up. Otherwise, you sacrifice your interest. So,
for clarity, you can touch it. You're just penalized a few months interest if you start pulling money out.
That's right. Yeah. That's right. So I think they're fine if you have a larger emergency fund, maybe, and you want to get a little bit better interest rate on a CD, because sometimes CD interest rates will be higher than a savings account. They're higher because you're giving up immediate liquidity and you're allowing the bank to have the money, quote unquote, locked up for 3 months, 6 months. They even have 12-month, 24-month CDs. I don't like those and wouldn't recommend it for an emergency fund because it's defeating the purpose of liquidity. That's ultimately the biggest driver of an emergency fund, and why you have it is for liquidity when you need it in an emergency. So again, CD, I think it's fine, but just wouldn't use it for an emergency fund unless you have a large buffer there. Then you can start to ladder out some CDs to get a little bit extra yield.
And I would also say, I'm not 100% sure where CD rates are right now, but I would say 6 months ago, CDs were paying, maybe I'll just use these numbers here. They're not exact, but maybe you were able to get 5.5% in a CD, called a year-long CD. Well, in a money market account, or a savings account, maybe you're able to get 5.4%. So that's just the decision. I think in our minds, it doesn't make sense for 1/10 extra of a percent locking your money up or some of your money up for a year when you can basically get the exact same amount and have that money fully liquid to you. Now, if CD rates were 7% and money markets were paying 4%, that's more of an attraction to try and put a little bit more in that CD if you're wanting to to get, I mean, 3 extra% is pretty meaningful. A tenth of a percent, not as meaningful in my mind.
The other argument for that is where it can make sense a little bit more for a CD is, the past 2 years, we've been in a rising rate environment. Interest rates have been increasing. We know at some point the timeline keeps getting pushed back, but at some point interest rates will go down. So that's where CDs can be beneficial, is because the interest rate is locked. A savings account and a money market account, those are variable interest rates, meaning they can go up, they can come back down based on the market rate. So the benefit could be you could potentially, it's difficult to do this, no one can do it. You could time rates. Let's say you get a 5.5% CD this summer for 12 months. What if immediately they start lowering interest rates? Well, you've got 5.5% locked up for 12 months. So even if interest rates fall 2-3% over the course of this next year, you're set. You've got your 5.5% CD. So that is the benefit. In a falling rate environment. You're being offered a rate that's probably not going to be offered anymore in the future, and you're locking it in for a little bit better time, as opposed to a money market or savings account. Your interest rate is going to be variable and immediately changing based on what the market rate's doing.
Yeah, that is a great point. It's just kind of comes back to that timing game. It's just, you just never know. And it matters with the speed at which they're going to cut rates. I mean, if they're going to go, slow like they did on the upside by raising 25 basis points for the last few hikes like they did, you're going to have some time to lock in at some higher rates. But if they were going to go from, 5.5 to 3 right away, you're going to see those money markets start to fall off pretty quick. But my gut says, and maybe you feel differently about this, Carson, but my gut says that it's going to be a slower cut unless we end up with something broken, which is on nobody's radar right now, but doesn't mean that it's not possible.
I agree. Whenever we talk about cuts, and we're at 5.25 on the Fed funds rate right now, it could be 4.75 by the end of the year. It's not like we're sitting here just going to go right back to zero. The other thought there is, the last kind of account has gotten popular over the past years, a money market account through a brokerage account, which is offering a little bit better yield. So, and we've had this conversation with clients in the past, and we have these types of accounts here, but it is you might hear about a money market mutual fund or a money market fund that you hold inside of a brokerage account. So all this is, we know the world of mutual funds where there is a manager running that portfolio. They pool investor monies together and they are able to invest it on larger scale because they have everybody's money together. So with a money market mutual fund, the objective of that fund is to invest in safe assets. And what they do is they invest in assets that don't have a lot of volatility. Their asset level is stable. Then they just pay out the interest on a monthly basis. So there has been we've shared some charts and graphs in the past about there's trillions of dollars in money market mutual funds right now. And they are able to offer a little bit better interest rate because they can buy millions upon hundreds of millions of dollars worth of CDs and short-term corporate paper, you name it, as opposed to a traditional bank, like your local bank, is operating very differently than a big, large money market mutual fund. So, Miles, would you recommend using a money market mutual fund as your savings account or your emergency fund?
Yep. Yeah, I don't think it's a bad idea. I mean, we've done a lot of due diligence on those types of funds, and I think as long as you're using a good quality one and looking at the track record, to make sure that they've never defaulted or cut withdrawals. I mean, it's a slight, full disclosure, from a compliance perspective, it's a slight riskier than a savings account because it doesn't have the FDIC insurance. But by that, I mean, if a savings account is a 0 or a 1, this is like a 1.5. I mean, if
like
that, I mean,
1.01 would be my argument, but
and specifically the fund we use has never defaulted through. And there's, I'm sure a lot of other ones out there that have done that, never defaulted that, through the tech crisis in early 2000s, 2008 financial crisis, COVID, money was always liquid in there and there was no concerns around that. That is one concern though. Some clients do just want the FDIC insurance. And so you go that route. You maybe give up a little bit of interest, but your money's fully guaranteed up to those FDIC amounts of, 250,000 per account type. That's
right. So we do have SIPC insurance. So it's not like the money's not insured. It's just a different type of insurance, but I think that's good. It's interesting because 3 years ago, we never talked about cash it wasn't even a part of our conversations. It's just make sure you have your emergency fund, but
Yep.
that's it, because it didn't matter where you had it because you were making 0%. Now, every single meeting we have, we're talking about cash to some degree and interest rates and making sure you're getting enough money. So it's interesting to talk about this topic nowadays, given we've never really talked about it. But I guess it's a good thing. You're making
Yeah,
interest.
I agree. Are there any other, just before we wrap up here, are there any other options out there? I know one that's off the top of my head is I bonds that have kind of come up where there's, the way they work is it's a bond that you buy directly from the US government. There's two components to it. There's the fixed rate and the variable rate. I believe the fixed rate's still at 0, but the variable rate got up there pretty high last year. And so people were asking, above 5%. I want to say it was at like 7, 8, 9% somewhere in there at one point. I'm not sure where it's sitting at today, but the pro is that fully insured by the government, and it was a bit of a higher interest rate. But with that, you had to hold it for a certain period of years. And Carson, do you remember what the holding period was on those?
Yeah, the fixed rate on them is actually 1.3.
Okay.
And the semi-annual variable rate's 1.97. Comes out to a interest rate of 5.27%. So you can still get a money market account better than that. But the downside is you have to. It's kind of worse than a CD with having it locked up, because yes, you can still get your money, but I think if it's inside of 3 years that you redeem it, you have to give up your interest or a certain portion of your interest. So it's definitely a longer term hold. But again, with inflation coming down, it's Series I, it's tied to inflation. So if inflation's coming down, it loses its sexiness since inflation's going away.
And I think the max you can put in is $10,000. So,
That's right. Yep.
if you're talking even a high rate, if you're talking where rates are today, a little over 5%, you're putting in 10 grand to make, $500. And you're having to go specifically through a government website to do that. Why not just simplify it yourself and find a good savings account or a good money market account that you're able to basically get that exact same amount from?
I agree. I like the KISS method. Keep it simple, stupid. Don't try to overcomplicate your cash accounts and getting 0.05% better and having to move all your banking accounts and deposits and so on and so forth, because it's ultimately not going to make or break you. So I like the bank I have, checking account's fine. Savings account gives pretty good interest rate. Is it 5.5? No, it's not, but it's in the 4s. So I'm like, it's just a savings account. I'm pretty happy with it. And there's always going to be a new option out there, but for the most part, make sure you have 1 month in a checking ish. Make sure you have a savings account. We always recommend anywhere from 6 to 12 months worth of living expenses. If you have any questions, then we can help.
And I would agree. I'm similar to you in that I have a checking that I operate out of monthly expenses, and I have a savings account that has more of my emergency fund in it. And it's not, I know that rate's not maximized out, but it's good enough. It's close enough for me that to me, it's not worth moving things around to get an extra percent or two. And I know it's safe and liquid. And then the rest of that's just building out the other buckets that we talk about to our plans. So, middle bucket, investment and retirement accounts, just making sure that my wife and I are hitting each of those on a monthly and annual basis. And just keeping things simple. That's what works for us. At the end of the day, what works for you is going to be best without having to overcomplicate things.
That's it.
So thanks for joining us again on the Retire While You Work podcast. Looking forward to next week, and we'll see you then.
See you then.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.